back, everybody, to We Are TPM with myself once again, Kyle Teixeira, sitting next to this guy, John Teixeira. We are back today to discuss what investors are doing in this market at the end of 2025.
What are they doing?
What investors are doing at the end of 2025's market.
Or just the current market that we're in?
Yeah, well, we're dating this thing. So if you guys have any questions about this, want to discuss next year or any time in between, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Let's get into it. So this sounds vague, but really we want to discuss what we're in the current market. There's a lot of speculation going on around everywhere, right? Some people think it's bad, some people think it's good, and usually when you're in these types of things and you got a lot of uncertainty or you have a lot of different views, it means that there's areas that may be working and areas that aren't, right? So you got to be on top of it. So what's the first one? It's
uncertainty. Just to hit on that, you're right, because uncertainty creates it creates a lack of movement, right? People, when they're uncertain and there's not a clear path forward to do whatever you're trying to do, in this case, build wealth with real estate, then less people do it. Yeah?
Yeah. I mean, it's but and then everybody thinks if nothing's moving, should I not buy stuff? Because then I can't sell it. So what are we seeing? We're seeing that deal flow is still happening. Deal flow is still there, but it's fast, as it would say, fast, not friendly. Like we're seeing a lot of first come, first serve deals, a lot of off-market deals with tight close timelines. Everything needs to be verified and do your own due diligence, all that stuff. And that's because it trickles down when you get into these higher paced markets, or you get into the markets where some things may not moving conventionally. Well, what do the people who need to sell faster do? They jump to a secondary market, which is what off-market deals are, generally at a discount. And because the off-market deals, because that needs the demand for or the supply of on-market deals is getting so high, now the supply of off-market deals are getting high. So the amount of available deals means that they're like, all right, we need to close these things quickly. Because it's the only reason they jump to them. It sounds overcomplicated, but
a little bit.
Fast,
but there's
not friendly.
I mean, I feel like there's not a ton on the market, on this traditional market. There's not a ton of desperate sellers.
Doesn't look that way right now.
But they are out there. They're just being snatched up by investors that are good at representing them in an off-market way so that investors can make a buck, right? So that investors can still find deals that will make them money, right?
Yeah, because it's not that the deals aren't scarce. It's good margins are, right? And that's what they're looking for is good margins. So
sometimes traditional real estate sales with traditional real estate agents, I mean, I love them and all, but sometimes they don't know how to put together these kinds of deals that investors are looking for. They don't know how to take advantage of the current conditions to get things done. And I think that's part of the symptom of what you're referring to.
Yeah, and we're entering a market where the good deals is what everyone's looking for, right? So they're not going to wait around,
Yep.
If you need 3 weeks to decide to run your numbers and everything, you're already out of that deal.
Yep.
Like if you're not going to consider that speed, then you're already out. So, are renters moving? We got renters moving.
Oh, goodness gracious, are they?
There's a new bar for leasing. We've been talking about it on this podcast for a while. It's becoming it's a very general way of saying it, but we've talked about a lot of different things to improve leasing. Or to make leasing better. This market's showing us that they're becoming requirements, right? We're talking about speed. Speed is now a competitive advantage.
Yeah. Yeah. You'll lose, well, I'm not sure, you'll lose applicants, right? If you have several applicants, you'll lose applicants not processing fast enough onto something else because they have so much to choose from.
Well, not just that. It's if this people are looking online, looking on Zillow or wherever they're at, and they see a rental they like, and they're looking for a house, then they want to be able to schedule a showing in an hour and go look at it in 2 hours and, make a decision, have an application in by the end of the night.
Yeah, technology
That is
allows
not
yep.
just the new way we've talked about a lot. It's now the requirement. They're not going to wait around for a listing agent to call them back. Even the fastest listing agents available with teams ready to do this, they're still probably going to pick the self too, or they're going to be left alone. So if you're not set up for that, you're failing. Most landlords can't even access those abilities. So making sure your property managers are using them is huge, because even we're in a market where those problems are making better listings go for less money because they're not being seen by the vast majority.
Another reason to consider using a great property manager. If you're doing it yourself, you can't afford all these tools, right?
Yeah, exactly.
That's why I said that, is because
we knew this was coming. We've been talking about it for probably 5-6 years, but friction. But when you get into higher supply with these special market dynamics, friction kills your deal, right? If it's between you and 3 other people and they saw yours today and they didn't see the others tomorrow, and the wife wants to submit an application tonight, which one do you think you're going with?
Yeah.
I'm going with the one that I put my eyes on.
Yeah.
You probably are too, and so is everybody else. So that's friction kills.
Yep. Friction kills. I like that.
Friction kills returns.
We should do a podcast called Friction Kills. I like that. We can make a movie called Friction Kills.
All right.
What do we got next?
Not a good friction return killer. So, STR market. STR, everyone's looking back towards STRs, where the STR market's been down. Probably it really still is down, but you can help adjust returns with STRs. Why is that?
Well, you could still get better returns if you're amenable to the way you do it, right? Meaning like the cash flow and how you get your money and when you get your money, and like if you're set up to be able to handle the down times and the slow seasons or whatever it is, then you could still do better with a short-term rental overall, even though it's down. Right?
Yeah, I mean,
it's not so far down that
becoming. It's what we've been leading towards. But it's really competitive right now, right? And when it's really competitive, quality has to be really high to make money.
Yep.
I got people starting listings. I've had a lot of not clients. I've had people who tried to become clients, decided to do them themselves, who have been on my phone lately asking how I'm succeeding in listings that they're not succeeding at, and sometimes it's just a simple answer of, well, the market's gone to professional management. That's the market wants that, and that's what they're going towards. I can't make you a professional manager, but I can tell you a good one. But it's the difference between upside and big risks, because STRs don't die slowly. They don't fail slowly. They fail suddenly. They get one bad review, and you're no longer getting bookings, and you get some platforms, you get 2 bad reviews. Now everyone that is back-to-back bad reviews, everyone who is booked with you gets an email letting you know, hey, did you see these 2 reviews? Make sure you still want it. Now you get cancellations, and it's not slow. It's a sudden snowball.
The STR business takes constant tweaking.
Credibility,
right? Yeah. You got to constantly be tweaking it, constantly be looking at it, being in your business. We did that podcast with Joel Verinder, who does a bunch of them in Tennessee, in the Smoky Mountains, and he's got some in Gulf Shores. And that guy is really good, right? He is right on top of his business, knows it upside down, constantly tweaking his listings, constantly tweaking his technology, making sure he's right on top of things, that the guest experience is constantly as good as he can make it, right?
Yeah.
And that's what it comes down to. That's what is required to succeed with a short-term rental.
And changing with the market and making sure your micro markets. I learned something interesting, because we don't talk a lot about midterm rentals, but we do them here. They're becoming a little more prevalent because they play that middle ground of literally midterm rental. They play that middle ground of over 30 days, so but still set up like a short-term rental. And a lot of people fail these short-term rentals. They're trying to protect some downside by converting them to midterm rentals, which is an interesting point that our market, Dallas-Fort Worth, I spoke to one of the success managers at Airbnb, and he was telling me, well, any other market I've ever seen midterm rentals, I don't suggest they don't do that good. He's like, Dallas Fort Worth is an outlier. That midterm rentals are very prevalent and succeed very well. He couldn't give me an answer why, other than there's a lot of travel and short-term stay living in this area.
I think there's just a flood of people coming into the area like no other, and people would prefer to not have to set up a home, rent a home. They'd rather come in and stay somewhere for a few months while they're learning the lay of the land, trying to decide whether they're going to stay here. Is this opportunity I've taken even one that I want to continue taking, or am I going to go back home? There's a lot of those kinds of people here, right?
Yeah. And we talked about there's probably 10 other reasons that is why it is here. You know, market dynamics, price of a midterm versus a long-term rental is probably closer than in most places. A lot of different things.
So wrap that up, because I feel like we're going all over the place. That's just short-term rentals is one more opportunity right now in the current market for our investors, right?
Well, as investors in this market, they're structuring their downside protection in a way that is planned ahead of time. So if you're buying a short-term rental, can it be a midterm? Will it succeed as a midterm? Will it succeed as a long-term? Asking all three of those questions is definitely something that's happening right now. So we're investors. That's who we're talking to. What are we buying? What are we telling people to buy? What are you passing on? What assumption? What do you feel is the stress test?
Well, to be honest, cash flow is hard in the traditional sense with your traditional single family residence. So you either got to create your cash flow by buying off market, like we talked about, do an STR so that you can cash flow a little bit more, which is not for everyone. So I don't suggest everyone go out and do that. But those are two ways to create that cash flow. If you have money that you want to pull out and put down into it so that you can create that cash flow, if that's what you need, then you can do it that way. But to be honest, those are the only ways in our residential market, other than, now's a great time to buy small apartment buildings if you're ready to start doing that, because
now's the time. It's
good for the market.
Good time to start buying things at a discount. The people who bought a market is set by the people buying in that market. And if the non-investors aren't buying, which they're starting to not buy, then the investors swoop in and start giving, these 90 days on market listings, 20% haircut offers. And I mean, it's not unfair. It's not worth what you're asking if it's sitting on the market for 90 days. So, and sometimes retail price, if you don't have retail customers, isn't going to be achieved.
Yeah.
So, and we see it time and time again when we try to buy stuff, like, because we see this with foresight. So I'm like, well, it's not worth that, so I'll buy you this now. All right, well, I'm going to wait 90 days. Well, 90 days, I'm like, well, you just proved to me that it ain't worth what I offered you 90 days ago. So now it's going down again. So, and then they're like, oh, well, let me try again. And then, it's like, well, you're snowballing in the wrong direction. So don't do that. Consider, comparables and what you can get, what I can resell it for is very important. So if things are on their way down, then I'm going to buy it for 10% less than it's worth today, because I need to make sure I can sell it in 6 months for what I bought it for. So
yeah,
that's what an investor mindset is. So
yep.
I think things are going to level out and start going the other way, but rates have gotten to a point where we could start turning prices around, but you never know.
I think you're going to get into this, so forgive me if I'm jumping into a topic too soon, but to your point, real estate activity has picked up, and everybody I'm talking to is confirming that. So we're at the end of the year. We're in a month where it could go either way. Well, but November, December is typically a month that is very busy or very dead. And year by year, it's always different.
Well, and, everybody likes to talk about interest rates and the Fed and all that stuff, but in very simple terms, like, they did lower prices 0.25%. That's not what again, this week, that's not what sparks the market back up necessarily. There's a lot of things that can spark the real estate market back up, but they did do something that's even bigger than that, and that's stop quantitative tightening and talk about switching quantitative easing in January. And You don't even need to know what that very complicated statement is supposed to mean and sound very complex. It's not as complex as they make it sound. It's either we're dumping money into the economy or we're taking it out. And in simple terms, they said we're going to stop taking it out and we're going to very likely start dumping it back in. Well, last time they did quantitative easing was 2020. And when they dump a bunch of money into the economy, they dump it into a bunch of hedge funds pockets or a bunch of Roth IRA pockets, whatever it is. They dump it into pockets of a bunch of people that spend it, and they spend it on assets, which is real estate, which is,
Yeah.
And that's why when Fed guys comes out and says that, Trump goes out and says, hey, buy stocks. I mean, it's a direct correlation. That's not a speculation. It's mathematical. So that's what I expect to happen. Now, whether the Fed actually does what they say they're going to do, now that's speculation.
Well, and we're to your point, back to your topic, what about our current climate is basically a downward trend of interest rates, or at least a flattening trend, right? It's come down a little, it's increased activity, and then when you add all those things to it, it's like everything is just kind of pushing just a little bit. It's just nudging the economy a little bit in the right direction regarding housing, right? And I kind of like it. It's not, nobody's freaking out and doing the things that we used to do after 9/11 and COVID and so forth, where we just started buying mortgage-backed securities like crazy to try to, stimulate things, overstimulate things. They're just nudging, and probably more appropriately. I know Trump hates it. Trump wants it to move faster so that he can say, look what I did. But
I mean, we don't want to get too deep into these topics, but it's a little scary to me because when you have economy's cyclical, and when you go through cycles where people don't get scared enough and think everything's going to topple down, then it never corrects enough, right? And then you start to get into, oh, well, it looks like everybody thinks we're never going to fail no matter what happens, and that's a dangerous mindset to have too. So, I know Warren Buffett came out the other day and said nobody likes when that guy talks, but his scare is the U.S. currency, and I'm like, that's a fancy way of saying that quantitative easing scares the hell out of him too. So you're devaluing the currency. That's what it is. So
yeah.
But he's sitting on a whole bunch of that currency, so I would be scared of it if I was 30% of my assets were in U.S. dollars. So he has a bias.
I wonder how much crypto he has.
Zero.
None?
Zero.
Well, if you don't like the dollar, then you probably don't like the crypto either. What else? What else are we doing?
His reasons for not liking Bitcoin ironically go against having dollars, but that's a whole nother conversation. What?
Sounds like another conversation. What?
2026 conversation.
Okay, there we go.
Maybe, right? Because we are at the end of 2025.
So what else are investors doing in the current market?
That's pretty much it, man. They're waiting for everything to... I'm just kidding. They're buying. Because at the front end of what I'm talking about, on the front end of any time the Federal Reserve Chair says anything about quantitative easing, before the government starts spending money, investors try to do it first. And that's what they do. That's what they're doing.
To your point, I am noticing that. I'm noticing investors are out there. They are active. They are moving. The big investors, the big hedge fund investors, they're setting up shop in some cases to buy another X amount of homes or whatever it is, right? And so, yeah, that's happening right now.
Well, yeah, and it's cyclical.
And they get ahead, to your point, they get ahead of everyone else. So the everyday investor usually follows, right? So when they're 6 to 12 months ahead of everybody, they've already been buying, and all of a sudden you've got this great idea. I'm going to go buy a house as an investment property. You're 12 months behind the big hedge funds.
Well, and what everybody's asking this non-investors, and even, a big question I've been getting at the end of the year, are we in a bubble? We love that question, right? I've been getting that for the last 5 years. Are we in a bubble? We're in a bubble. Well, I'm not going to say whether we're in a bubble or not, but I will say how bubble dynamics work is generally you have to have a huge run up in that bubble for it to pop, right? if you think we've had a huge run up in the last 5 years, we have, but it's been. My point is, if investors are starting to buy now and telling you that we may be in a bubble, that means they're saying they're buying now. Bubbles could last a year, they can go 5 years, they go 20 years. You never know.
I think you need to explain that because I do not understand what you mean by what you mean, like a bubble on sales prices. Like
that's always my question when everyone asks for in a bubble. I'm like, bubbles are not. There's never been an economic bubble. There's an industry or something that is in a bubble that pops, and that causes
bubbles don't always pop. They inflate and deflate.
There you go.
That's been cycle.
My answer. I'm like, well, we're always in a bubble, or a deflating bubble, an inflating bubble. Like, right. You need to understand what that question is before you ask it.
They're actually what people are really asking is, are prices too high and is everything going to crash? And the answer is no. It's been flat for a long time. We've gone down, and bubbles aren't guaranteed to pop. That's the answer I've been giving. It's like, well, unless you don't, even we aren't. They're not guaranteed to pop, and I'm not going to say we are at all. I'm just saying I've been getting that question a lot. They don't, from an economic standpoint, they don't ever pop. They deflate a little bit. So how much do they deflate?
What's the real question? Is commercial real estate in a bubble? Hell no. Is residential real estate in a bubble? I wouldn't call that either. No. Is there an interest rate bubble? Is there an asset bubble? Like, what's the question?
There might be a stock market bubble.
There might be a stock market bubble.
I think that's the only one legitimate one.
By definition, there is a stock market bubble because of the price per earnings and because of that multiplier. Well, how many times has the multiplier been in the current state and not popped? Oh, dozens. I mean, a whole bunch of times. 2021, 2023, 2020. I mean, like, and that's only the last 5 years. We could probably go. The point is, you don't predict that way. But when the Fed says they're about to start quantitative easing, investors start buying before they do. That's a cyclical fact I'll give you. So there's your answer.
I can attest to that is happening.
All right. That's all you need to know. Boom. Mic drop. Podcast done.
We're done?
Take it easy.
Bye.
Well, if you have any questions on this, probably don't call us. But if you have any questions on...
You can call me. I'll talk to anybody for any reason. Exactly. Let's go.
He really will. He's not lying. 817-818-9039. He'll talk to anybody, so let it be you.
But don't email me at
show me the money at wearetpm.com because he definitely will not see that.
I won't see it.
I will see that, though.
Kyle will see
someone
it.
Will see that. So someone will make sure we see that. Give us a call. Thank you for tuning in, and check out 2025. See y'all in 2026.
Boom.